Global markets are currently experiencing a significant wave of volatility. A primary factor driving this turbulence originates in Japan with the unwinding of a widely used investment strategy known as the yen carry trade. We'll now examine what this is and why its reversal is creating financial ripples around the world.
The immediate catalyst can be traced to this figure, 1.95%. This is the yield on Japan's 10-year government bond, its highest level since 2008. This single data point is signaling a fundamental shift in global financial conditions.
Our analysis begins in Japan, where a shift in monetary policy is the root cause of this widespread market instability.
The increase in borrowing costs is not isolated to the 10-year bond. Yields are rising across the spectrum of Japanese government debt. The 20-year bond now yields 2.85%, and the 30-year bond is at 3.4%. These are multi-decade highs, indicating a decisive change in Japan's interest rate environment.
Market consensus now anticipates further action from the Bank of Japan. The central bank is expected to raise its key interest rate from 0.5% to 0.75% in December. This move, while seemingly small, represents a clear signal that the era of near-zero interest rates in Japan is concluding.
To understand the global impact, it is essential to understand the mechanics of the yen carry trade and why it is now unwinding.
The yen carry trade is a financial strategy based on interest rate differentials. For decades, investors have borrowed Japanese yen at very low, near-zero interest rates. They then convert that yen into other currencies to purchase assets in countries with higher interest rates, profiting from the difference in yield.
The process involves 4 steps. First, borrowing yen at Japan's low rates. Second, converting the yen into a foreign currency like the US dollar. Third, investing those funds into higher-yielding global assets such as stocks or bonds. The final step is to capture the profit from the interest rate spread.
The critical question for markets is why this long-standing and profitable strategy is reversing course at this particular moment.
Investors are facing a two-pronged pressure. First, as Japan's interest rates rise, the cost of borrowing yen increases, eroding the profitability of the trade. Second, the Japanese yen itself is strengthening. This means investors must use more of their foreign asset profits to repay their original yen-denominated loans, creating a currency-related loss.
This unwinding is not a localized event. The reversal is causing significant ripple effects across global markets, with a pronounced impact on emerging economies such as India.
In India, the effects are visible across several market segments. The equity markets are witnessing outflows from foreign institutional investors, leading to heightened volatility, particularly in small and mid-cap stocks. The Indian rupee is under pressure, recently depreciating to 84.90 against the US dollar. India's bond market is also experiencing volatility, influenced by these global capital flows. Compounding the situation are several other factors creating market uncertainty. These include an upcoming U.S. Federal Reserve meeting on December 9th, crude oil prices at $63.83 a barrel, unresolved trade negotiations, and ongoing geopolitical tensions involving Russia and Venezuela.
Given this complex environment, we now turn to the perspective for long-term investors and how to navigate the current volatility.
It is crucial to frame the current market action correctly. This is being widely described as a liquidity event, driven by the repositioning of capital rather than a crisis rooted in a fundamental deterioration of corporate earnings or economic growth.
The guidance for long-term investors is clear. Maintain discipline and adhere to established investment strategies. The focus should remain on high-quality assets. The primary directive is to avoid making panic decisions based on short-term market noise.